Being able to identify liquidity is the easiest way to turn profitable fast. I use liquidity sweeps in literally every single trade that I take, and it's helped me make over 7 figures. So in this video, I'm going to help you guys identify what liquidity is, where it lies on the charts, why we even use it. So with that being said, let's jump on the charts and let's get into it. So the first thing that we want to understand is, where does liquidity lie in the market? And it's as simple as liquidity lies above highs and below lows. So in order to identify where liquidity lies, we know it's above highs and below lows in the market, but we need to be able to identify what a high is in the market and what a low is in the market. A high is 2 candlestick pattern, a move up, then a move down. A low is a move down, then a move up. And liquidity lies above highs and below lows. And you're probably saying, well, PJR, holy shit, liquidity is everywhere on the charts. Yes, liquidity is everywhere on the charts, and liquidity is how the markets move, okay? Us pushing above highs, that is going to fill orders that are either going to push the market and continue the trend that it's currently in, or it gives the market the opportunity to reverse. And that's typically the second option is typically what I take the majority of my trades off of, which is when price comes up above a high or below a low and is reversing the current trend that it's in, okay? So that's what I'm going to show you guys today. But the first thing that we need to do is just being able to identify where liquidity lies. And I'll give you guys a quick little summary of why liquidity lies above highs and below lows, but it's pretty simple. Like I said, there's a shit ton of orders that are resting above highs and below lows. So if we think about an uptrend, okay, how do uptrends move? This is beginner shit, right? Higher highs and higher lows. Awesome. When we push above a high, we're expecting it to go higher if we're in an uptrend. In a downtrend, we move in lower highs and lower lows. So when we push underneath a low, what are we expecting price to do? Continue lower. Now, this is great in theory, right? And a lot of retail traders, maybe some of you beginners, you guys see an uptrend, and then the second that price pushes above the high, you're like, awesome, that's confirmation. We can press buy because this is going to go to the freaking moon. Now, sometimes that is the case. However, the best opportunity for us is being able to catch the bottom of the new trends and the top of these new trends. So ideally, if we're taking a trade, we don't want to be pressing buy right here because we're already pretty deep into this uptrend. Ideally, we want to be pressing buy down here when this uptrend gets created, and we want to be pressing short or pressing sell up here when this downtrend gets created. And the only way to do that is by being able to identify liquidity. And again, where does liquidity lie? Above highs and below lows. So we're not trying to be trend traders, we're trying to be reversal traders. That's what's worked for me. That's what my entire strategy is based off of. It's based off of liquidity sweeps and then seeing a trend form out of that so that we're able to either catch the bottom or the tops of moves. It gives us a much better win rate, gives us a much better risk to reward. Overall, just a better way to trade instead of following a trend and potentially getting stuck in a situation like this where we press buy above this high and then price just reverses, right? That's not what we want to do. We want to be pressing buy when price is really low as it's starting a new uptrend to be able to catch this entire move up instead of just trying to get a pipsqueak ass move that's this big, right? So that's what liquidity lets us do. And now, because we know liquidity lies above highs and below lows, that can give us signals or give us an idea of where orders are lying and where price can potentially reverse. Now, just like I was telling you guys before, what do we know about uptrends? They move in higher highs and higher lows. So let's say we're in an uptrend right here and we're moving in higher highs and higher lows, and we have a high right here, right? Just like I was telling you before, there's a lot of beginners. As we push above this high, because we're in an uptrend, the beginners will be like, time to press buy again. Now, above highs, what do we know? There's resting orders. There's liquidity, okay? There's potential orders that can get filled. Now, because we're pushing above this high, what happens? What orders actually are getting filled so we can visualize this and actually understand what's happening? When we push above a high, there's the retail beginner traders that are saying, hey, we're in an uptrend, we're going to go higher. So they're placing buy positions right here. Then there's also people, because again, this market can go both directions. There's also going to be people who were trying to short this move down or press sell on this move down. And where is their invalidation point or their stop loss going to be? Well, it's going to be above this high, because if they were correct about trying to sell this move down, then the move would go down and it wouldn't continue the uptrend that it's in, right? So their invalidation point is going to be above this high. So what does that mean? It means, if they're pressing short, then they're going to have to buy back their position for a higher price, in turn causing a loss. So they're also placing buy orders. So there's 2 forms of buy orders that are happening here. People that think the uptrend is going to continue higher, and then also people who thought that this was going to start a downtrend who are getting stopped out of their position. All in all, there's a shit ton of buy orders that are resting above highs in the market. Now, what does this give the market the opportunity to do when it's ready to change directions and cause a big reversal in the market? When we push above a high, it gives the market the opportunity. This is the key word. It gives it the opportunity, because we know uptrends, we move at higher highs and higher lows. So every time we push above a high, does that mean the market is going to reverse? No. Does it have the opportunity to reverse? Yes, because there's resting orders above these highs. So when we push above these highs, we know that there's people getting stopped out of these short positions. We know that there's people that are pressing buy because we pushed above a high in the market. Awesome. So that gives the market the opportunity to fill a massive amount of sell orders and cause a reversal. Because if we think about basic, just economic high school class, right? How does the stock market work? If I want to buy one share of Apple stock, I have to have somebody that's willing to sell a share of Apple stock to me. It's an exchange, okay? And that is what these awesome brokerages online have digitalized for us, so we kind of lose the concept, but that's what's happening on a daily basis. And specifically with the market makers and the market movers, in order to push price in the direction that they want it to go, they need to be able to fill their massive amounts of orders. So me wanting to buy one share of Apple, I don't have to press buy underneath a low or try and press sell above a high, because one share of Apple, there's millions and billions of people that are doing these transactions on a daily basis, right? There's people that are willing to sell their shares of Apple for X and Y reasons. There's people that are willing to buy shares of Apple for X and Y reasons. But when it comes to actually genuinely moving the markets and moving these massive indexes and actually causing a change in price, this is humongous amounts of orders that need to be filled. So with that being understood, the market makers can't just place a massive short position right here, because that would cause the market to fall. And also, what do we know about the market makers? They want to have the best price possible for their short positions, because they're never going to lose money, right? So they're not going to want to press short right here. Why? Because it would drastically affect the price. Because if they place their massive short orders right here, it would cause price to go down. And only a portion of their orders would be able to get filled here, because not a lot of people are probably willing to be buying here. Maybe there's some people willing to buy, but not enough to fill their massive amount of short orders. So what happens? They're only able to fill some of their orders here, and then what happens to price? Price moves down, and then they're going to get filled on more of their orders, and then price moves down, they get filled more on their orders, price moves down, filled more on their orders. All in all, for them to fill the amount of orders that they want to fill, it would just be a constant move down, and then their average price is going to be like dead in the middle, and that's not what they want, because they want to liquidate their positions down here for a super awesome profit. But the profit's not going to be as good if they get filled here, and all the way down. What do they want? They want the best price possible, and they want to fill all their orders in the exact position that they plan on and at the exact price that they plan on. So how are they able to do that? By waiting or pushing price above a high where they know that there's going to be a massive amount of buy orders entering into the market at this point in time, so that when they press sell, or when they enter into their sell positions up here, they're able to fill every single one of their orders up here and then move price in the direction that they want, because their sell orders got filled. So now that we understand why and how we're looking to identify liquidity on the market, we'll talk about it in the downtrend version. So again, we're not just pressing sell every single time we push above a high and below a low in the market just because there's a potential move that could happen there, right? This is just one concept or one confluence in the strategy that makes the market move, okay? And identifying liquidity, it's actually very easy, because you literally just go onto the charts and you just mark out all the highs and lows, and you're like, okay, awesome, this is where price could fill or price could end up reversing off of that, and then we can use other confluences to end up building a strategy around this. Okay, I'm now going to show you guys what it looks like in a downtrend. So again, when we're in a downtrend, we're typically making lower lows and lower highs. So again, what lies underneath lows? We'll do this super quick. There's a bunch of sell orders that are going to get filled underneath lows. Why? Because again, if we're in a downtrend and we push underneath a low, what's going to happen? The retail beginner traders are like, price is in a downtrend, so I'm going to press short because it pushed underneath the low and it's continuing market structure. Good job, Timmy. I'm about to destroy your stop loss. That's how I'm thinking every single time the market does that, and I'm trading in the opposite direction. Okay, these dumbasses, they're entering short when these lows get pushed underneath, and little do they know that's the worst time to go short. And then there's also the people that thought, hey, price is going to reverse right here, and where's their invalidation point? Again, if they bought somewhere within here and we're in a downtrend, they thought price was going to reverse, where would their invalidation point be, and where would they have to sell those shares back for a lower price, taking a loss? Or where would their stop loss be? Their stop loss would be underneath the lows, because that would be continuing the downtrend. So all in all, liquidity is just using manipulation if you think about it, because again, what are we manipulating? We're manipulating both sides of the market, okay? Because there's people who are pressing buy here, so the buyers are getting stopped out, but then also the people who are pressing short, once we get underneath these lows, are also getting stopped out because that's when we're reversing. It's kind of like a fuck you to the buyers and a fuck you to the short sellers. I'm the only one that's going to make money today. And that's pretty much how the market works. The market's a zero-sum game, okay? There's always going to be a winner and there's always going to be a loser, okay? Not everybody can win these things. Now that we understand that, and now that we understand where liquidity lies above highs and below lows, and we also know that we're not just pressing buy every time the market pushes underneath a low, and we're not just pushing sell every time market pushes above a high, we just know that the market has the opportunity to fill their orders and push price in the direction that they want to. Now that we know what it looks like on a squiggly line chart like I've drawn here, let's show it to you guys on an actual chart. Now again, we want to remember how or where does liquidity lie above highs and below lows. How do we identify a high in the market, a move up, then a move down? How do we identify a low in the market, a move down, then a move up, okay? It's not a move down, then a move down. Believe it or not, some people, the brain cells on them, there's not many left after watching TikTok, okay? It's very, very little left. And they think a move down and then a move down is a low. No, Timmy, we need a move up because it causes the peaks and the valleys, okay, buddy? We'll just do this super quick and I'll show you guys examples of this happening in real time, okay? Let's do an example right here, okay? We have a high right here, okay? Move up, then a move down, the highest point of those two candlesticks, awesome. We mark it out with a little line. Now, obviously, this is cherry picked because I'm getting on the charts and I'm identifying, like, obviously price reversed off of this, but it's proving the point here. So look, okay, we have a high and then awesome, we're in an uptrend, right? We have a high, then a low, then a high, then a higher low, and then a higher high, but oh no, we're gonna reverse off of that. Why? Because a lot of people were pressing buy when these highs got pushed above, okay? And then a lot of people who were selling on this move down, where's their invalidation point above these highs? What does that give the market makers the opportunity to do? Fill all of their sell orders right here and say fuck you to the sellers and then say fuck you to the buyers. We're stopping out both of you guys today and we're the only ones making money. And that's why liquidity is so important, because it's all just off of manipulation. Let me show you guys another example and just prove to you guys that liquidity, it's a real thing, okay? Let's see here. I mean, it happens on every single time frame. It's literally as simple as this right here. Like, this just happened in the market, okay? We get a big move down. Oh my gosh, we're in a downtrend. Look, all of these people, we see this big move down, okay? Drake's dick is on the screen with this candlestick. Boom, we get a break of structure to the downside. Holy shit, we're gonna go lower. And then, okay, we have a low right here, and then, oh, what do we see? The market goes down. Oh, we push past this low. All the idiots, what are they doing? They're pressing sell. And then also, all the people that thought they were geniuses, when they see this big move down, they're like, oh yeah, dude, price isn't gonna move any lower. You're right, price probably isn't going to move any lower, but you're still dumb. Why are they dumb? Because liquidity hasn't been swept yet. How is price going to move higher if the market makers haven't even been able to fill their orders? How are they going to have to fill their orders? They have to generate a low, and then they have to sweep out the low to push price higher. This just happened in real fucking time, and actually I made a significant amount of money on this move up today. So again, there's the people that say, holy shit, Drake's dick is on the screen. I'm gonna press sell when we push underneath this low because that's confirming that the downtrend is continuing. Idiots, boom, you guys are getting stopped out. And then also the people that were pressing buy on this candlestick, they're also idiots. They're getting stopped out because the orders haven't been filled yet. Where do the orders get filled? For the buy positions, down here, and then boom, price ends up moving higher. It's like fucking clockwork, and it shows up on every single time frame. Now, I'm going to show you guys, or tell you guys, the best time frames and opportunities to use liquidity sweeps, because it's one thing to see a liquidity sweep happening in real time, or to be able to identify it on the chart. Like, I can go here and I can show you a million freaking liquidity sweeps, like, right? Okay, boom, price comes underneath this low, sweeps liquidity, awesome, we move higher off of that. Price comes up, sweeps out this high, boom, Drake's dick is on the screen, okay? We see price come down right here, sweep out these lows, awesome, we move higher. We see price dump down, sweep out these lows right here. Awesome, price moves higher, okay? Liquidity sweeps are on every single time frame. Price moves up, sweeps out these highs, moves lower. It's how the market moves, okay? I can show it to you guys on the weekly time frame. I can show it to you guys on the daily time frame. I can show it to you guys on the 1 minute time frame, okay? Okay, this is a monthly liquidity sweep. What are we in? We're in a freaking uptrend, okay? And then, flash crash, we come down, we sweep out this monthly low, we sweep out this monthly low, and then what do you fucking know? It gives all the richest people in the world the best opportunity to invest in their good old-fashioned S&P 500, and next thing you know, they're up 50% on their portfolio for the year, okay? This is how the big people make their money, okay? By identifying lows and highs in the market, okay? And capitalizing on it because of liquidity, okay? Now, the best time frames, or at least for the way that I trade, to be able to identify liquidity on, for me, is going to be the 4 hour and the 1 hour. Now, why is this important? Because I'm trading market open at 9:30 a.m. Eastern time every single day. And for the most part, when new money comes into the market, or every single time that market opens, there's new money coming into the market. So how is that new money going to move the market? It needs liquidity. Good, we're learning, because how does the market move? Through liquidity sweeps, okay? So the first thing that I'm looking for is 4 hour highs and lows within the market, okay? I'm also looking at hourly highs and lows within the market. Like today, oh dude, it was a perfect example. I caught these longs up here and made multi-six figures on this move up. I did it on NASDAQ, but same exact market structure. Let's look right here, okay? This is market open at 9, okay? I look during pre-market, what did we do? We came down and we swept out all of these lows right here, and then we started reacting to the upside. Awesome. So what do I think is going to happen? Price is going to move higher, okay? We see price come down, sweep out this low, this low, this low, and then we see reversals off of it, right? Boom, price comes down, sweeps out liquidity. How do we know that orders were filled? Dude, look at the fucking chart. If price comes down and takes out a low and keeps going down, is it a liquidity sweep? Fuck no, because it's not reacting to it. That's why we want to mark out all the lows and all the highs. Look at these highs. Okay, we have these highs right here and these highs in the market right here. We very well could have swept liquidity from these highs. But did the market react to these highs once we pushed through them? No, we didn't. We pushed higher. So we're not looking to press short. We wait for reaction, okay? So we can sit here and we can mark out all of these hourly lows that are stacked up, so we know, okay, there's a shit ton of sell orders right here. There's a shit ton of sell orders right here. There's a shit ton of sell orders right here. Let's take all of them out so we can fill our massive amounts of buy orders, and then boom, price starts reversing. So all that we're looking for off of these liquidity sweeps is reversals. Okay, and I have a whole bunch of other videos that go over in depth, okay, and a strategy of like how to spot other confluences to be able to spot these reversals early and often, and to be able to execute and find entries. But today's video is just specifically on liquidity and identifying it on the high time frames and see how it moves the market, because this is such an important concept for you guys to understand. So again, if we're looking at the 1 hour, we see, okay, we have a 1 hour low right here, a move down, then a move up, awesome, this low, move down, then a move up, awesome, this is low, move down, then a move up, awesome, this is low. Price comes down, takes out all of those sell orders. What does it give the market makers the opportunity to do? Fill all their buy orders. How do we know that it's a proper liquidity sweep? Because we literally see the reversal on the low time frames. We see a change in trend. We see a change in market structure on the lower time frames. And then what the fuck happens to price? It moves higher, okay? It's one of the most important concepts in trading. Yes, a lot of people neglect it, and I have no freaking clue why, okay? And like I was saying before, this shows up on every single time frame. Again, what I like to do is, because I'm trading New York market open at 9:30 a.m. Eastern time every single morning, for the most part, I get on, I mark out the 4 hour highs and lows that the market could be able to sweep or has swept either during the previous session, during pre-market or London session. And if liquidity hasn't been swept during those sessions, then awesome. I'm expecting New York market to open and then for us to sweep out liquidity during the current session, and then I'm going to take a trade off of it. And just like today, if I see that liquidity has already been swept during pre-market and we're already reacting off of it, awesome. Then this was the liquidity sweep for the day, and I'm just going to take a trade reactive off of this. Okay, I'm not looking to be taking a trade off of a liquidity sweep from New York market open, because the liquidity sweep already happened. Okay, I'm going to show you guys a couple more examples of this happening, just so you guys know that this is the real fucking deal. I mean, yeah, bro, this is gorgeous. Let's look here. This is New York market open. Okay, we have this high. Again, what am I doing? I'm just marking out the highs and lows. Okay, so we have an hourly low right here. We have an hourly low right here. I'm just gonna do this real fast. We have an hourly high right here. We have an hourly high right here. We have an hourly high right here. Awesome. Let's look in here. Look at this. Market opens. We rip up. Boom, take out liquidity. Boom, take out liquidity. Boom, take out liquidity. Boom, take out liquidity. And then what ends up happening? Reaction. We end up dumping down. And then the nice thing about liquidity as well that I failed to mention, not only can we take trades off of it and be able to find short and long positions up here, we can use it as a target because think about it. Again, we need to understand these confluences to have the confidence to be able to take these trades, and it also gives us context for why price is even moving in the first place. Price comes up. Awesome. We fill sell orders. We fill the massive amount of sell orders. So awesome. Boom. Our entry's up here. We need to get rid of these sell orders. We need to make money on these sell orders. So just like how we fill sell orders above highs, where are we supposed to offload these? We can't just offload them right here because that's going to cause the market to boom, rip up. And then just like in the previous example, like I was explaining, we try and offload our positions here, buy back our short positions for a lower price to be in profit for the day. Price is going to move up and then more of our positions are going to get filled here. Price is going to move up, more of our positions are going to get filled here. We need people to be willing to go in the opposite direction of us. So where is price going to move now? Or where are they going to push price to be able to offload these positions? Underneath lows, because underneath lows, what are people willing to do? They're willing to sell, and we're already in sells up here. So what are we going to do? We're going to shit the bed on the market. We're going to push it underneath a low. And then once we get it underneath a low, we're going to say, fuck these guys. Boom, I'm going to buy back my positions for a lower price. These people are going to sell at this point, and the short side of this buyback right here, I make profit on these shorts. These guys then end up getting fucked again and stopped out. It's how the market moves. So just like how we get filled off of liquidity, we're looking to target draws on liquidity to exit as well. So I use draws on liquidity not only as entry points, but also as exit points. It's literally the only way that I look for entries and exits from the market because it's how the market moves. I'll show you guys another example. When price comes down and sweeps out, okay, look, it happens in both directions here. Boom, 4-hour high right here. What does price do? It pushes above the high. Hey idiots, everybody going long here, you guys just got fucked. We're going to fill all of these sell orders right here. Bye-bye. We dump down. Now we're entered into a whole bunch of sell positions. So now what are we going to be looking to target? We need to target a draw on liquidity to be able to offload these sells. So we need to push price down to a point where people are going to be willing to sell, where we can buy back the positions for a profit. So where is that going to be? It's going to be underneath lows. So there's a low right here, there's a low right here, and then what do we see price do? Boom, price comes down underneath this low, and then literally, oh my God, it's so good. Look what price does right after coming underneath this low. Boom, we come underneath this low, and then again, we get underneath a point where people are willing to sell. So awesome, we can buy back our positions for a profit. And then what happens to the market? Right after moving underneath this low, we get a little relief, and then price moves even further down. Boom, underneath this low, people are pressing sell, absolute dumbasses. Again, we were able to offload all of these short positions and boom, buy them back for a lower price, giving us a profit. And then boom, what does price do to them? Says, fuck you. Okay, now let's go over the other direction. Boom. Now we just came down, swept out these lows. Awesome. Everybody is pressing sell. When we push underneath these lows, we see, boom, change in trend. Awesome. We're pressing buy. We filled all of our buy orders underneath here. Now that we have a bunch of buy orders filled, awesome. We have entries right here. We need to find a spot to exit. So what do? We identify a draw on liquidity. Awesome. These were the 4-hour highs that we previously used to make the move down. Awesome. We have buy orders right here. Where can we sell them back for a higher price to be in a profit? Where are people willing to buy our shares? We bought all of these shares down here for a cheap price. As price goes higher, we're in profit. So when we're in profit, we want to sell these shares for us to make money. And again, there's a shit ton of orders that are filled down here. So we can't just be selling right here. That's going to tank the market and then boom, we're fucked. So what do we need to do? We need to convince people to buy our contracts at a higher price when we're in profit. Where are the dumbasses willing to buy? above these highs. Why? Oh, because we pushed above a high and the uptrend is continuing. Awesome. We're gonna drive price up, push above these highs, and then boom, we're able to exit right here. It's like fucking clockwork, guys. There's truly no better confluence in trading than liquidity sweeps. Argue with a fucking wall. It's how the market moves, okay? It's how orders get filled. And if you guys aren't using liquidity sweeps, you guys are stupid. Hopefully you guys enjoyed this video. I'll catch you again.